Now, currently, if you think about it, Treasury gold is valued currently at $42. And okay, so if we revalued at today's price, well, actually, we were above 2,900. We just made all-time highs again, despite attempts to knock it back down. So even if you picked arbitrarily 2,900, that would inject around 900 billion into the Treasury General Account. That would be via repurchase agreement. Now, the suggestion, as this may offset the need to issue quite so many Treasury bonds this year, so from a high level.
Currently, U.S. Treasury gold is valued at just $42 per ounce. If revalued to today's price, around $2,900, it could inject roughly $900 billion into the Treasury General Account via repurchase agreements. This could reduce the need to issue as many Treasury bonds. Additionally, if the U.S. plans to issue long-term gold-backed bonds, a higher valuation, such as $3,000 or even $5,000 per ounce, could further support this strategy. President Donald Trump and entrepreneur Elon Musk have expressed interest in verifying the gold reserves at Fort Knox. Treasury Secretary Scott Bessent reassured the public that annual audits confirm all gold is accounted for. Also, economist Judy Shelton has proposed issuing 50-year Treasury bonds convertible into gold to stabilize the dollar and address the shortcomings of the monetary system. AndrewMaguire, a seasoned precious metals expert, explains that gold remains in strong physical demand despite repeated attempts to lower prices through paper trading. While technical traders went short after a pullback, gold quickly rebounded as Asian markets opened, reinforcing its physical strength. Spot gold has now fixed above $2,900 in 11 of the last 14 sessions, with central banks, sovereigns, and institutional buyers continuing to accumulate regardless of price levels. Andrew highlights the ongoing pattern of the West selling, while Asia buys underline a shift in market control. Despite attempts to create artificial tops through paper market manipulation, each price dip brings fresh investment demand, pushing gold to new stair-step highs. This mirrors the rally seen after the launch of the Shanghai Futures Exchange, which blindsided paper market traders. Liquidity providers report that physical gold availability remains tight, with demand exceeding supply at current prices. While short-term paper market corrections occur, they fail to increase physical bullion supply, further solidifying gold's long-term bullish trend. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
But we also saw several technical traders dutifully reporting they'd gone short after Friday's bid-pulled gold rinse. But it didn't go unnoticed by physical market participants that spot gold quickly recovered as soon as Asia came in on Monday morning, illustrating its strong physical demand that is calling the action, and spot gold is now fixed above 2,900 for its 10th time out of the last 13 fixes, and it'll be 14 out of 14. Sorry, it'll be 11th time out of 14 at the PM fix, because this is where the round number equivalent is. And what it does is illustrate no matter how much paper gold is thrown at the 99.9% paper settled COMEX market, it's strong physical demand that is now calling the action. And this is just Wednesday. And notice from the pit open all the way to the market close we actually evidenced 130,000 contracts. That is over 400 tons of paper bullion, successfully cleaned out. And what it did was actually get rid of the fresh speculator longs added after the first fix on the 10th, which was here, the first fix above 2,900. It got rid of all of them, basically just rinsed them all out, and which is actually constructive. So into this wash and rinse process, really, gold has already recovered and is being heavily purchased by central banks, sovereigns, and fresh institutional buyers who really care not about 2,900, 3,000, or 3,500. They want gold. But note, Asia buys, the West sells. It's the same mantra that we've been watching for quite some time. It's tiring, and it's about to stop. Now, with officials severely on the back foot, we don't count out more bid-pulled attempts, which we just looked at, to try and chart paint a top. However, each of these froth rinses brings in offsetting fresh gold investment demand, assisting in carving out higher stair steps, just like we evidenced after the Shanghai Futures Exchange launched back here. Now, I always come back to this chart because it illustrates, we saw about an 800 back rally, then it settled $600 higher by the end of the year. And this is why we actually drew this similar circle, saying this is the same sort of input that we saw when the Shanghai Futures Exchange launched. This is another huge rally in the making. And we'll keep this chart regularly to provide good context. And if you remember, when the Shanghai Futures Exchange launched, it also blindsided the paper market actors who were at the time spinning that shortages were short-term in nature, and we all know how that turned out for them. Daily phone calls around all the desks continue to evidence first-tier liquidity providers reporting the real action is physically driven and that there is insufficient bullion being made available to deliver at current prices, with Asian-facing physical gold and silver demand is consistently overrunning available supply. So while shorter term we always expect some healthy paper market consolidations, none of these wash and rinse cycles.
Andrew recalls that gold was historically traded as a foreign exchange cross against the US dollar, allowing the US to manipulate its price and maintain dollar dominance. However, this changed on January 1, 2023, when the Bank for International Settlements reclassified gold as a top-tier asset, giving global central banks an alternative to dollar-based reserves. This shift restricted the Fed's ability to fund deficits and led to the unwinding of gold swaps and leases, leaving only the US and UK central banks attempting to suppress gold prices. For over 50 years, Western central banks borrowed and sold gold to suppress prices, but physical gold has now been absorbed mainly by global central banks, particularly in Asia. Instead of repurchasing at higher prices, central banks doubled down on leasing more gold, which no longer works as physical supply has vanished. The US Treasury's 8,100-ton gold reserves may exist, but due to decades of rehypothecation, ownership is uncertain. Andrew points out that with no recent audits and rising paper-to-physical gold spreads, the actual market price of gold must rise significantly to reflect actual supply and demand. Central banks and sovereigns continue accumulating, setting the stage for a significant gold revaluation event. Now let's dive into the interview.
Gold used to trade as a foreign exchange cross against the dollar, so the gold market has historically been manipulated by the United States to maintain the dollar's dominance in global reserves. So namely, keeping gold financial reliance on the debt-backed US Treasury securities. It was competing. However, in a nutshell, and as we've been following for 2 years now, all this changed on the 1st of January 2023 when the Bank of International Settlements reclassified gold as a competing first-tier asset class. For the first time in history, gold challenged the dollar's over 50-year exorbitant privilege, providing global central banks a sufficiently liquid alternative dollar investment vehicle that restricting the Fed's ability to fund its growing budget deficits. And this was the exact point the European Global South facing Bank of International Settlements short-covered the last remaining 500 tons right there of accrued gold swaps and leases, leaving the US and the UK central banks as the only remaining central bank trying to cap gold against the dollar into continuing efforts to tamp down a rising gold price rivaling the US dollar. Up until the 1st of January 2023, Basel III compliance, spot FX gold had traded on an unallocated cash settled basis. And as with every other foreign exchange cross, long or short positions could be cash settled amongst the Albanian market making bullion banks, with only a tiny percentage of these hundreds of tons of foreign exchange gold traded every day ever physically delivered. And the reason the remaining two central banks, which is the Fed, the Bank of England, have not yet been able to comply with freshly instigated global Basel III NSFR structure, physically backed structure, where all FX gold positions have to be physically backed, basically, is because over 50 years of accrued price suppression, which required central bank physical gold to be borrowed and sold into the marketplace, has been scooped up by global-facing central banks on a one-way journey out of Western exchanges, never to return. It's gone. Worse, historically, instead of buying back the gold at a higher price and repaying these leases on a timely basis, it was common practice just to double down, borrow more central bank bullion in the hope of swamping the market with enough bullion to rig buying back lower. And you could do that before China came in and said, no way, baby, we'll take it. However, every ounce they sold into the market has completely disappeared. And as we highlighted in granular detail in our last episode, these Bank of International Settlement leases had to be repaid to the Bank of International Settlements at ever higher prices. But there was no way of buying enough bullion to repay 50 years of accrued, severely rehypothecated US and related Bank of England gold leases without triggering this revaluation event. Now, look, no one knows the degree of rehypothecation relating to this 100 tons of US gold. People say, is it even there? Well, it's probably there, but who really owns it? That's the question. Therefore, it's not possible to estimate how much gold has to be bought back at market to repay these double ownership, triple ownership, quadruple ownership positions. And of course, there was been no audit since the 70s, so how does anyone know? One way or the other, unprecedented paper to physical exchange for physical spreads have exposed the paper to gold abyss. And the offer price to sell real physical gold will have to rise to an equilibrium level significantly higher than at current paper diluted prices. There's a massive gap to fill.
Gold's increasing role as a top-tier asset challenges the dollar's dominance, with central banks accumulating physical reserves amid declining Western control. The growing disconnect between paper and physical gold markets signals an inevitable revaluation as supply constraints and global demand drive prices higher. As central banks shift their strategies, gold's long-term bullish trend appears firmly in place. How might a significant revaluation of U.S. Treasury gold impact global financial markets? What are the potential consequences for the dollar if gold continues to gain favor as a reserve asset? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.